Hi there, everybody. I'm Miranda Alt with Keller Williams Success Real Estate and the Miranda Alt team. Happy Wednesday. We are here for Wisdom Wednesday. Haven't done a few of them in a while over the holidays, took a little hiatus from it, but we're coming back in 2023. And I figured what better way to have our first interview of 2023 to be with Melinda from Motl Accounting. Melinda, thank you so much for joining me today.
I am pleased, and this is awesome. And hi, Miranda. We're the two
Yeah.
M's today in our kind of pink and purple.
Trying to be kind of winter, but like bright winter. That's like kind of what I think of with pink and purple. So you're sticking with the theme. I like it.
Exactly. Getting out of the seasonal depression here and putting happy colors on for
That's right.
not so happy subject, taxes.
Taxes. The two things that you can't avoid, death and taxes. So Melinda, I wanted to talk to you today because I figured this is the time of year that we're all sort of like switching out our old files, starting up our new files for 2023. What are some of the documents that people should make sure that they are pulling aside for their tax accountant?
Okay, I was going through this last night, and of course we always have the typical W-2s, obviously 1099s. Now, in the last couple of years, they changed the name, and it's called a 1099 NEC, non-employee compensation. They also have 1099Ms, is which they used to be for miscellaneous income, like royalty income, rent income, other things like that. Those are the two biggies, but other things that are often forgotten are the W-2Gs for gambling income. They do those, yes. And
I would have never thought of that.
What's kind of fun this year, I mean, we're tax accountants here, so we get thrills out of the little things. Illinois has never offered a tax credit for the other states when you have gambling income from Indiana or Wisconsin. So you go across the border, you have to pay state taxes to both states on that big jackpot or this little jackpot.
Hold on, I didn't know that.
Yeah.
Wait, so if you win in Vegas, you pay tax in Vegas and then you come home and you got to pay tax on it in Illinois too?
Well, let's just say Vegas doesn't have an income tax, but let's just say they did. Yes.
Okay.
So if you go on the river or you go to Wisconsin or you go to Indiana, for the weekend, yes, you pay taxes in both states. Or New Jersey, that's a big gambling area.
Wow.
Until this year now. So now this is the first time ever. So here's the gambling pitch here.
Wait a minute. So is this new for 2022 or new for 2023?
The seminar I attended today was 2023, or it might be 2022. They were not good about distinguishing that because we're starting the 2022 tax season. So I really can't answer that question.
I have a friend who won $100,000 gambling this year, so he would probably be interested to know this information. Crazy.
Yeah, that's huge. That's huge. And I'm going to guess 2022 because that's what we're discussing.
Okay.
Is the 22 Illinois state tax changes that came out today.
Roughly.
Okay. So I was in the webinar today with the University of Illinois Tax School learning this. So now for the first time ever, you get a credit for the taxes that you pay to the other state. So you don't have to pay Illinois and the other state that you earn the income in.
I mean, that seems good.
Yeah. Yeah. So for the big jackpot winners, that's nice.
Yeah.
So the other thing that people always forget that's really important, if you have kids in college, that 1098T, each one is worth about $2,500 to you on average. If you're making above $100,000 a year, it's $2,500 of cash in your hand. And the kids, it comes out in the kid's name. So you have to grab that from your kids because they'll think, oh, to them it's worth $1,000 because they're the lower income. So all their friends say, okay, you've got your 1098T, let's file the taxes and you get another $1,000, but it's worth $2,500 to the parents. So that's something to be on alert for.
Okay.
Grab that 1098T from your children.
Okay.
That are at university or in trade school.
And that's 1098T as in Tom?
And tuition.
Got it. Tuition. Okay. 1098T.
Right.
Okay.
What else? If they're less than 24 years old, you can claim it because they're still considered your dependent.
Right.
Another form that's associated with that, if you've done some investing into BrightStart or state funded programs, is the 1099Q. So that's when you pull out. So that's another form, is if you're investing to the state of Illinois or other states' college education programs, pull those forms, BrightStart.
I have
And you
those.
can up to $10,000 per taxpayer.
Okay.
So, and that's only a tax deduction for the state end, but say married filing joint, you each put $10,000 into your child's future
Yeah.
education. That's $20,000 offset of
Right.
taxable income.
Right.
So that adds up.
For
That's a
sure.
big one.
For sure.
Another thing that, and this is the number one that holds your taxes up, is your investment statements. And generally people who are purchasing homes know what dividends are and interest income and stock sales and mutual funds and who Vanguard is and Raymond James and Wells Fargo Wealth Management and all those other fun, Charles Schwab, all those other fun places. They're called 1099 OIDs or 1099Bs, and they tell you how much money you made in the stock market or
Okay.
with your certificates of savings and your dividends.
Well, and you said something about people who sell their homes. I know that all of my clients, if they bought or sold a home this year, they're going to need their closing statement. They're going to need their HUD.
Yes. And they're 1099S. So I give you one guess what S stands for.
Sale?
Yeah.
Is that what it is?
Yes.
Oh, good.
And
I got it.
I cannot prepare your tax return without that 1099S, because that's what they're telling the IRS. So Motl's computers have to talk to the IRS computers, and those numbers have to match.
Right.
It's not like, I think I sold it for $500,000.
It's like, no, you better have it at 501. Like exactly.
Yeah, you better have it at 501. And with
Yes.
that 1099S, you
Okay.
also have a homeowner, if you lived in your home 2 of the last 5 years, an exclusion of $250,000 per person. So that's $500,000, 500,000 per couple filing joint. But with that, again, what to give your tax accountant is you need the date of when you purchased that home and what you roughly purchased it for.
Now I've lived in my home for 17 years. I don't have that, right?
Yes, you still have to worry about it, because yes, you did the first step. You've been there 2 of the 5 years, Miranda. But then say you sell your home for $1 million and you bought it for $250,000. You just made a $750,000 capital gain. Now, because you're married, you'd file joint, you can write off $500,000 of not being taxed, but that $250,000 is going to be taxable income.
But what if I take all of my profit and I put it in another property? Then I don't have to worry about it, right?
That's a business thing. That's a whole other webinar.
Okay,
That's a
got it.
whole
Yeah, we
other.
will not complicate things with that. Okay.
We'll do that on another Wednesday wisdom.
Okay, got it. Deal.
Talk about that. But again, you can write off your selling expenses, your realtor commissions, and all those things. And generally, this doesn't apply. But the whole point I'm making is you have to establish basis. You have to say, hey, I sold my home for $1 million. I bought it for $600,000. Or I bought it for $500,000 and I put $100,000 worth of improvements and I paid my realtor $25,000. So then you know what, that takes up that $500,000 gain and you pay zero taxes. So that's why it's important to give to your tax accountant that 1099S and what you recall roughly, what you purchased your home for. Now, if you're right on the border, right. If you're right on the borderline of that $500,000, you need to pull the records out and be exact. But if you know you're not really making much of a profit, it can be guesstimated. If you knew you purchased it for $400,000 something and you sold it for $600,000, we just need that $400,000. And you think you bought it in June.
Right. Yeah. Right.
10 years ago.
Yeah. Right. Okay.
So,
and then don't people all, and they all need to gather their mortgage statements for how much interest they paid on their mortgage.
Right. And that's a 1098. Guess the initial.
I? Is it right? Is it I?
Because I love my mortgage. No, it's 1098M.
Oh, for mortgage. No, I thought I for interest.
Oh, that's good. I like that. That's the 1099 INT interest. So yeah, that makes sense. But no, it's a 1098M, meaning you paid out. So if you want a little tax lingo on forms, 1098 means you paid it out. So you paid the mortgage company. the 1098. Income you receive in is a 1099.
Oh,
So another thing that you need is your 1099 G for government, which is your unemployment income.
geez.
I know it just gets on and on and on. It's really simple
Like a
though.
lot.
It is a lot, but you don't, you want to get your taxes done in once, you don't want to have it last over a month because
Right.
you want to give everything at once to your tax preparer because so then they can get it done. Because the minute you get put off that to-do pile, everybody else's taxes come in that have everything ready,
Oh,
and then
for
you're
sure.
suddenly on that burner.
Oh, yeah. Melinda, when did I file my taxes for 2021?
That's for you to say. I have confidentiality.
I think it was October of 2022 when it was finally done. It
Right.
was not
So we
on
had to,
time.
right, because we had to find information.
It was super complicated.
So she's saying it, not me. Not
That's
me.
fine. I can say it. I can say it. I'm complicated. I've never tried to claim to be easy. Never, never in my life.
That's what I
Simple is
like.
not a word that I know well.
Simple is boring and
Yes.
non-productive
Right.
and
Right.
predictable, but yeah.
All right. So anything else we need to know
Yes.
about Melinda?
Yes.
Oh,
You
gosh,
need
there's more.
also, now normally because the standard deductions are so high, and for 2023 and 2022, it's a little over $25,000. So that's a deduction that they just give you automatically that encompasses charity, interest, medical, property taxes. We need your property taxes because that's a deduction on the state side and a possible unlikely deduction on the federal side, but we still need it to make that determination. Is we need, if you paid a lot in charity, I mean, a lot. We're not talking the $500,000 because it's not going to pull you over that $25,000 standard deduction. Right. But if you're a great tithing payer or you have a lot of money that you give to charities, we need that amount. If it's going to push you over with all those other qualifying expenses over that $25,000.
I have a question for you. So I have a question. So every time I go to Goodwill and I drop stuff off and they offer to give me that receipt, you told me I shouldn't ever need to take it.
No,
tell me why.
Because first of all, that deduction is limited to $250, $250 to $500. Anytime you go over certain amounts, you have to have that audited. You have to have it appraised. And it's not going to make a difference anyway, because did you donate 20? Okay, say you paid no mortgage interest and you paid no other expenses. Did you pay over $25,000 worth of Goodwill? It wouldn't count anyway, because $5,000 up, you have to have it appraised. So really, unless you're teeter-tottering on over that standard deduction, generally it's not worth it. And then the amount of money that you're going to save is not worth the flags.
So if I had $15,000 in taxes, property taxes that I'm writing off, and
you're
then
already screwed because you can only write off $10,000.
Oh, that's right. I forgot about that.
I know, I know.
So the limit on property tax is $10,000. Okay, so I've got $10,000 that I'm running off of my property taxes, and only if I wrote another $15,000 in charitable contributions,
right?
Then
right.
Start to itemize all of these other donations that I've done to, and even then, the Goodwill, it's only what you can only write it down, write off up to what, 5,000?
500. Well, I'll go up. Some tax preps will go up to 500. Other firms will go up to 250. But I'm going to tell you a secret. You spend more time, your tax preparer will spend more time doing those receipts because of how the IRS requires reporting. It will raise your tax bill more than you'll save in tax money.
Oh my gosh, now that's a good point. Okay. All
right.
Because
it is the worst form to fill out. They want to know everything that was on that receipt. When you purchase, the value was, what your estimated resale value is. So if somebody gives me 10 receipts, their bill just went up $100 and they might save $5. Do you see what I'm saying? Or $10 because of my time.
So those Goodwill and Saver receipts are completely useless.
Useless.
Got it. Okay. Anything else we should tell people?
There's too much fraud on them anyway.
Yeah, I bet.
But there are a few cases where they will make a difference, and then obviously we take care of them and we don't charge them a lot. We won't charge them more for it because it is making a difference, but those are few and far between.
And
anything else?
if you donate like a car or something like that.
Right, and that's different, and that's totally different, but it's a misnomer. And
Okay,
again, charity, your $1,000 charity generally is useless.
okay, all right.
Now, what's really important to know, how about the tax deadline?
Oh yeah,
This
what's the tax deadline?
this year it's April 18th, 2023. And then if you extend, Miranda,
Why are you talking to me, Melinda? I don't have any idea what you're talking about.
you're given another day. So it's October 16th, 2023. And those are important dates.
Yeah, they are. What about
So
for businesses filing? Aren't they due sooner? Businesses are due
they
like
are.
March.
It depends on the type of business. S corps, partnerships are due March 15th. Trusts, estates are due April 15th.
Got it. Okay.
Yes.
Okay.
Right. And
And
then
this is complicated stuff.
I know, especially and like I K1s and such, and like I say, K1s are going to come out later. Anyway, people generally with K1s extend. It's
Yeah.
just normal. The more complicated the returns are, it's just normal that they extend. What else wonderful and exciting? They raised because of inflation. Now this is funny, haha, for all the cynics in here. The tax rates on the income that they're going to tax went up 7%. So that's a good thing. So say you went up a
That
tax
sounds
bracket.
bad, Melinda.
I know it does, but it's inverse. Okay. It's bad when I explain it. Say, for example, you're at the tax bracket of 10% up through the first $10,300 that you make. They raised that 7%-ish. So let's just say now for 2023, you're in the 10% tax bracket up to the first $11,000 that you make.
Oh, so they increased sort of like your allotment, almost like your
That's a better word. That's a better word, is your allotment.
okay,
But
how much you're allowed to
did
make before you're in the next tax bracket.
Yeah.
Got it.
But
Okay.
did inflation go up 7%?
Yeah, it was at
No.
8% for a while. So
10% and groceries 30%. But that's about the only good news that I
okay.
can tell you about the taxes this year is that they did increase the standard deduction a bit and the tax allotments before your rate increases went up 7%.
Gee, thanks, Uncle Sam.
I know. I know.
Well, I appreciate your time. Is there anything else that we should let people know about, or you think that's a lot. We just gave people
A lot.
of information to think about.
Right.
And there are also, as we were talking before we started recording, there are going to be how many more audits this year?
Well, they've hired 88,000 new IRS agents.
88,000 new IRS agents this year. So there will
Right.
be 88,000 more people doing audits, and however many more they can do, they will do. So
That's a good way of looking at it. Some will improve communication, answering phones, customer service, which again will free up other people. But the IRS director actually came out and said the main focus of these additional IRS agents are to do oversight and audits of the tax returns.
okay, good times, especially in fields like realtors and real
Yeah.
estate investors. So that's
Yes.
fun.
Yes, and then I'll leave on this note. Please don't forget to sign up for whatever you can afford on your 401ks or your HSAs, because that's pre-tax. That income is taken out of your taxable income.
Yes.
So however your work plan is set up, talk to HR. Don't forget to make that election.
That was one good thing I did in my 20s. When I was
Good.
working for a corporation, I knew I was like, just take my money before I see it because I'm going to spend it. Once you
Right.
get the money, it's gone.
Right.
If you take at least as much as you possibly can, I'll at least save a little bit of money. So,
Right. So if you've had an early withdrawal or something has terminated your ability to have the automatic deductions, since you don't see a physical paycheck every 2 weeks or every week, sometimes those contributions stop and you don't know about it.
oh, geez.
Like
So
happened to
make
me.
sure you're doing that.
Yes.
Yeah.
You know, because you don't notice the paycheck change that much,
Right.
especially at the start of the new year with the withholding tables. Make sure you're contributing what you should to your Roth or your 401k.
Okay. Good advice. Thank you, Melinda.
You're
Well,
welcome.
That was a lot. Thank you for watching. I hope you enjoyed all of this information. I will try and give you some brief synopsis and links to the Motl Accounting page and answer or put a list of all of those forms that Melinda was talking about as well. I'm Miranda Alt with Keller Williams Success Real Estate. Thanks for watching. Melinda with Motl Accounting. Thank you again. And I'll be sure to put your contact information as well.
All right. Thank you, Miranda. Have a great week. Happy sales.
You too. Thanks, everybody. Have a great day. Bye.